In 2000, the dot-com bubble bursted. That resulted in significant changes to the first significant change to the capital market since 1929. What happened because of that? Investment banks would no longer would utilize IPOs to fund startups with multi-billion-dollar potential, and the need for private marketplaces at this point started to stir. Okay, next slide. This is a good example. Yahoo, and keep in mind that Yahoo, eBay, and Amazon, all of these companies did their IPOs. They were all startups. Yahoo had $1 million in revenue for fiscal 1995. Okay, yet it raised $35 million at a $350 million valuation. So it was a startup for all sense and purpose. Okay, Yahoo was. Yet you made over 200 times your money. Okay, next slide. eBay. eBay is another one. Valued for raised $63 million on its IPO at a $600 million valuation in 1998, and it multiplied by 36 times. Okay, that was never to happen again after those IPOs because there was so much risk that the investment banks refused to do it. So what happened next is in 2002 to 2004, the web user population had doubled again, and that provided the critical mass for MySpace, Facebook, and LinkedIn to all become to basically start the social media industry. Okay, next slide. Okay, this is the Facebook chart. You can see what happened. Facebook went on and it grew to 2 billion users as a good example. Next. Okay. In 2005, the first startup accelerator, Y Combinator, was launched. Within 10 years, the startup accelerators, this is what I found. I can't find any data on them, but I would imagine there's at least 500 to 1,000 of these things probably around the world now because of their business model and because they're the natural, after a company gets into an incubator, just to explain to everybody, an accelerator, once a company develops its product in the incubator, which there were 7,000 of them in 2016, they then graduate to an accelerator, and that accelerator helps them scale the model and helps them market their product and gives them advice on how to market the product. Okay? Y Combinator, the first in 2005. In 2007, the launch of the smartphone accelerated the potential web population. Why? If you see the blue line here, this is about what the web growth was back in terms of the early stages. And then, of course, when the smartphone was introduced, that took everybody. Since you didn't have to have a line, an actual telephone line, if you're in the middle of Africa or in the middle of South America, you could get on the web with just being on your phone. The demographics soared from 2 billion to 6 billion is what happened for the web in 2007. Next. Now, as I said to you earlier, in 2008, the need emerged for a private marketplace to come into being in 2000 when the dot-com bubble crashed, because what happened was the shareholders of Facebook and LinkedIn and some of these social media companies, they wanted to get their shareholders, their employees, liquid, and they wanted to delay going public. They didn't want to subject themselves to the public markets. So what happened is there was the second market started to emerge, Shares Post and Second Market, a private market. These markets emerged, and in 2016, there was $70 billion worth of securities that were sold by shareholders of private companies that are unicorns, large, big companies. Okay. Now, this slide here, in 2008, the smartphone app industry emerges. Okay. And now, all of a sudden, the $10,000 investments in this new industry in 2008 through 2012 netted, 16,000 to 200 million. And the important thing about these were all angel investors could have put 10,000 into all four of these companies. That's what's interesting about this. The smartphone industry, app industry emerges. So next slide. From the end of 2020, or to now, or the end of 17 through 20, there's going to be 1.4 million new apps that will hit the app stores. So the opportunities to invest in apps are abundant. Okay, there's plenty of investment opportunities still out there to invest and to make those kind of returns. Next slide. In 2010, Dodd-Frank passed. The Dodd-Frank Act was passed, and that passage and its enforcement changed the capital markets forever. It established criminal liabilities for the brokers, and that destroyed the financing and liquidity ecosystem for small and micro-cap public companies. Okay, because what happened is prior to Dodd-Frank being passed, if you had a problem with your broker, you would take them to arbitration. Now, if your broker loses your money, they can be criminally charged, prosecuted, and imprisoned. This is the first time in the history of the capital markets this ever happened. So what that was, as a result, that's destroyed the ecosystem for small public companies forever. Anything in small public companies, and it's at the same time expanded the PE multiples and has reduced the volatility for large cap companies. Look at the next slide. Next slide. Okay. So you can see here, this is the low price stocks. They're in the blue here, versus the S&P 500 from 94 to 2017. You can see here that the trend lines start with the big stocks up red, the green, the little stocks following them from the 2000. You know, the 2000 market, the big stocks were at a premium to the little stocks. Then they both crash to 2002. Then the little stocks take off and are growing faster than the big stocks. They both crash again in 2008, 2009, and then look what happens. Then they both take off again. This time the little stocks take off ahead of the big stocks, but when after Dodd-Frank is implemented, look what happens. The spread has diverged to the biggest. This has never been like this in the history of the markets. Okay, it's a huge problem. Okay, next slide. So in 2011, the first TechCrunch disrupt event was held in San Francisco. Why was this significant? This was significant because prior to this time, the only way a guy could raise capital for his new business was to either go to New York on Wall Street and find a brokerage firm on Wall Street that would fund him, or go to Silicon Valley and find a venture capitalist. Now, with TechCrunch holding this event, TechCrunch is a division of AOL. These are big events, and they're held 4 times a year all over the world. So when they held this event, it marked the first time where entrepreneurs, entrepreneurs who were starting businesses, startups, and disruptors could attend events that were also attended by angel investors, venture capitalists, and regular investors. So now, with these events, 500 companies go to these events, 5,000 investors go to the events, and there's matchmaking going on at these events. Now, these events, since then, are now going on everywhere. Every major university in the United States now has an entrepreneurship program and is holding events like this. Every capital city in the United States is holding events like this. So there's now a way for investors and companies, startups, to congregate, and that basically has increased the amount of startups and investors who can participate eventually. Okay, next slide. So in 2012, the Jobs Act comes along, and it lifts the bans that have been in place since 1933. It allows private issuers to advertise to raise unlimited amount of capital versus via Title III. So now a company can hang out a shingle and it can advertise online to raise capital. And the second thing is it also enabled a private issuer to raise $1 million per year from unaccredited investors from SEC-approved and regulated portals under Title III. So now, for the first time, an investor since 1933, an investor, your son, anybody at any age, can invest $100 into a startup company. Okay, for the first time since 1933. Okay, It also allowed the companies to raise up to $50 million per year from unaccredited investors under Title IV. Okay, that's another thing. Okay, now the problem with that is that was a great thing that happened, but the regulations that the SEC implemented for the Jobs Act to lift those bans were very restrictive. They restricted the company, the startup who wanted to raise capital, from doing any marketing activities prior to their going out and attempting to raise their first million from the public. Okay, so they're a company. They said, you can't advertise until you have your offering has been approved by the SEC, and you cannot prime the pump. So a business can't come out and tell all of its customers, hey, we're going to have an offering, in a month from now to raise capital. Go sign up so that you get the email. No, that's against the law. So the SEC restricted all that. Okay. They also prohibited the regulated platforms, the SEC regulated platforms, from selectively curating or recommending any of their listed deals over another. So the problem with that is if you have 1,000 companies listed on a platform, if there's 1,000 entrepreneurs that want to get capital from the public, the public's not going to go. The platform cannot say this deal's better than any other deal. So it's like going through a phone book, the white pages of a phone book, and figuring out. You'd imagine you have white pages with doctors, all doctors listed in it, and you had to go in and try to figure out what these doctors do, and you're going to try to call 1,000 doctors to see which doctor you want. That's ridiculous, okay? So those restrictions that the SEC created created a need for unregulated intermediaries, or what I call social investing communities, to provide the free content and education to enable the public, which has no experience in investing, to invest, and enable the public so not to have to sort through hundreds of thousands of startups, because the community could tell the public, hey, this is the one we like the best of the companies we're looking at that are on the crowdfunding platforms. Okay, so there was a real need for this was established when the SEC slapped those restrictions in place. Next slide. This is an article that I wrote about this in 2014, in October, saying, so I said, crowdfunding needs to get back to its roots. It needs to get back to where it was in the 1800s, because you have millions of people that don't know how to invest, have never invested, the masses. And what it needs is it needs these social investing communities, similar to what happened where Henry Lehman went out and got the community to get behind the railroads. That's what needed to emerge as social investing communities. Next slide. Okay, so in 2014, the development of the digital social investing community models begun. Okay, the first one was Dynasty Wealth, and it was it focuses on startups with 100 to 1,000 times potential, and of course you have Trophy Investing, Apps Funder, and Sprout Up. These are all four of the original SICs that were on the drawing board back in 2014.